Good morning and welcome to today's webinar. We're looking today at 5 things you must know about your financial figures, and these are 5 things that you should be on top of every day as a business owner, not just in a time of crisis or downturn, but these are things you should know about your financial figures on a regular basis. So we're going to dive into those very soon and look into why those things are important and what they do tell you about your business, and why they are very much critical to knowing how successful you are and where you are on track for your business. So before we get started, this information is general. Please, if you need specific advice, contact a professional chartered accountant and get specific advice to your circumstances. So good morning, my name is Paul Sweeney. I'm the founder of Pretium Solutions Proprietary Limited. We're business growth advisors. We're chartered accountants working with small business owners, providing accounting and business advice. So I am a chartered accountant. I'm also a certified business advisor and the president of the Northwest Sydney chapter of the Institute of Advisors in Australia. So it's a little bit about me. So I'm also qualified as a registered tax agent. So let's get stuck in. So when you think of your financial figures, how does it make you feel? So a lot of clients will say to us that they don't understand their financial reports. They've never had them explained to them, and they just feel overwhelmed. They don't know where to start. They don't even know if they're correct. How do they know? Can they improve the business, or how much do they need to improve their business by, without understanding what those key concepts of the financial reports are and what they actually mean? What does it tell you about your business? So we're going to look into those things today. We're going to focus on 5 of the key things, and these 5 things, once you understand how these 5 key financial figures interact and what they tell you about your business, it should help you to focus a bit more, or a lot more actually, on what you're going to do to improve your business. So what are the 5 things we're going to focus on? So the first thing is profit, and that's something that it's a familiar term, but I think there are still a lot of business owners out there that do not understand fully what profit is, and importantly, how that differs to cash flow. So we're going to also examine what we mean by cash flow. And these 2 things are probably the key. Now, profit and cash flow are both essential to a business, but they are very different things. And we'll explain what they mean. We'll go into that detail. The other areas we're going to look at is inventory. And you might say, well, I don't actually sell physical product, but you do have inventory in terms of products or services or packages that you sell. Your physical services are in fact a way of inventory, and in the professional services area, we often call that work in progress or materials in progress. So it has different names, but we'll have a closer look at that. Debtors, this is often accounts receivable. It's another name for it. And we're going to look at creditors. Now, those 5 things are all interrelated. They all have an effect on each other in one way or another. And we're going to examine a bit more about how they work together and why you need to focus not just on one of those 5 things, but all of them, to have a really strong, robust business that can survive and grow. So that's the starting point. But the key here is that all of these numbers, all these financial figures, are really meaningless unless they're accurate. If they're not accurate, then it makes it very hard to know whether they are actually a good measure of the truth. Are they the correct figures? If they're not, you can get widely different results. You might think you're making a profit, and if you're actually making a loss, the decisions you make are going to be very different, and you can actually increase your loss by continuing on the same course of action. So accurate information is important, but also timely information. So it's very important to get those financial figures processed accurately in a timely manner and as efficiently as possible. Now, that's another aspect of running your business that we can talk about, but we're not going to go into a lot of detail today about efficiency. Efficiency and timeliness in record keeping is very important, and I encourage you to jump online and check out our recording of our session on record keeping. So what types of records should you keep that tell you about your business? They're important to give you an accurate picture of your financial affairs. So it helps with making financial planning, decision making, tax returns, how much tax you've got to pay. If you ever have a tax audit, you've got to have accurate records in place. Dealing with the banks are asking for more and more information these days. When you're selling a business, a buyer will want to see how you have constructed your financial information and that the source documents actually back up the picture that you're telling them. It's also a good way, and hopefully you won't have to ever come across this of detecting theft and fraud in your business, particularly when you're employing other people, and how you actually know whether you've got success in your business. We've got a good feel for it, but how do we know whether we've actually achieved the results that we wanted? So we need to have accurate financial figures, and we need to keep those up to date regularly. So records that you need to keep, well, in a very modern time, a lot of information is stored electronically, supplied to us electronically. Can we keep it in an electronic format? Yes, we can. What's the best way to do that? In a format that is as close to the source as possible. So the less you have to edit the information to get it into your accounting system, the best. So using a system that will capture your purchase invoices and attach them to your accounting entries with a minimal amount of effort, that is ideal. You do need to have those bank statements. Good to keep even the PDF copies of statements and invoices and wage records. Now, there are some statutory obligations about how long you need to keep information, what kinds of information you need to keep. But it's very important to have that information in place to support the financial figures that you're showing, particularly where we look at government obligations and particularly around tax. Tax and employees are very important to have accurate records for. So you need to look into those and make sure that you are keeping them in the required format. So let's move on and start looking at the first of the key financial figures. And this is one we all like to talk about, is profit. Now, what is profit? Quite simply, it's what's left over from revenue when you take off your expenses. And this is where the simple explanation starts to get a little bit more complex. So in very simple terms, profit would be, I sell something for $100 and it cost me $30 to make it. So I've made $70 of profit. And that's a very simple way of looking at what profit is. But it does get complicated by things like when we buy inventory, but we haven't actually sold it yet. So until we sell it, it's not an expense, it's still an asset. So people get confused by thinking that they've spent $5,000 on inventory and they've only made $1,000 of sales. So therefore we don't have a profit. We actually have a loss of $4,000. But the reality is we've still got $4,500 of that inventory sitting on the shelves. So the reality is our profit is $1,000 of sales, take away $500 of inventory that we've actually sold. So it does get a little bit confusing. And we're talking about revenue. So what do we mean by revenue? And this is important as well because we need to know what makes up revenue. And we'll come to why these factors that create revenue are important and how we can manage that a bit later on. So stick in there. We've got a bit of a bonus at the end after we look at the 5 things. So talking about revenue, what is revenue? Revenue is effectively your sales. But when we look at sales, sales is made up of the number of customers we have, the number of transactions that we have with each customer, and the value of each sale. And that's important to know, because if we can increase any one of those three variables, so if we can increase our customers, or increase the number of transactions we have with each customer, or maybe increase the value of sale, then we're going to increase our revenue. And that's really important. And if the example that everybody knows of this is the classic McDonald's approach of, would you like fries with that? So they're very good at upselling and increasing the value of sale by selling a small item on top. But for a lot of businesses, one of the keys is increasing the number of customers, or how you actually get your customer to come back. So revenue will drive profit. Without revenue, you won't have a profit. So we need to look at how we can increase our sales revenue. And that's just one aspect, though, of profit. There are actually 4 ways to increase profit. Increasing revenue is not just the main one, or the 3 components of revenue. What we need to do is focus on all 4. So the first 3 we've started to talk about. So increasing the number of customers. So if I move from 10 customers to 20 customers, my revenue will go up, and all things being equal, so will my profit. If we can get customers to purchase from us more frequently, that too will increase. So if I'm selling to a customer once a year and he spends $10,000 with me, but if I can get him to buy a second time and he spends $10,000 each time, then I've got an extra $10,000 of sales. So by increasing the frequency that a customer buys from us, we can increase our revenue. And that might be going from somebody purchasing 12 times a year to 13 times a year. Just those small increments all add up, because we remember we're multiplying by the number of customers we have. And the third one we talked about was increasing the average value of each sales transaction. And again, that's the McDonald's, we'll commonly refer to as the McDonald's theory, or the adding fries to the transaction. So, it is not a difficult thing, because once you've already got the customer there, it's a lot easier to sell more to them than getting them in the door. So we can focus on increasing numbers of customers, the frequency they buy from us, and the average value of transactions. And that's a common way to grow. So a lot of people will chase this revenue growth, but they will still end up being unprofitable. They will make losses from their activities. They're doing a lot more, they're busy, sales are going through the roof, but they're still making a profit. And the reason is that you need to have an efficient system of how you produce your revenue. So when we're increasing sales volume, we might get to a point where we need to hire more employees. So we might need more people in the warehouse, or we might need more sales staff, or we might need an office manager to manage the day-to-day administration and finances of the business. So we may need to put on additional team members. Now that comes at a cost, and that's quite a lumpy cost. So you've got to hire somebody, so you've got their wages, their superannuation, extra insurance. You might need to provide a place for them to work, computer. So you've got a lot of costs up front, and the increase in sales may not automatically increase by the same amount of the wages. So our costs will increase in a lumpy fashion. If we're also not efficient, so we're selling things that customers don't actually want, or they're badly described and they keep sending them back, or we've got to rework, then what's going to happen is that your efficiency from your operations is going to be reduced, your expenses are going to be higher, your profit is going to be lower, and you may actually end up without a profit. So getting efficiency and accuracy correct in your operations, not having surplus expenses that you don't really need, not having expenses that don't generate income or revenue, they're not going to help with increasing profitability in your business. And that's an important thing. So we need to manage the expense side as well. So profit driven by revenue, but we need to focus on how efficient we are using our resources to create a better, stronger profit. And linked to that, profit and cash flow. Now, cash flow is the amount of cash available to your business. It's the difference between the cash your business pays to suppliers, to finance companies, to purchase assets, to purchase inventory, to pay employees, and the cash it receives in day-to-day activities, which could be hopefully from a lot of sales and also from borrowing. Now, there is a huge difference between cash and profit. And this is something that we often get asked: how can I have a profit when I've got no money in the bank? It's a very common question we're asked, particularly when we're saying to people, you've made $20,000 more profit, but they've got $20,000 less in the bank than what they had. So where has that gone? So profit, we talked about how you might purchase inventory, but if it's still on the shelf, sitting there waiting to be sold, it's not actually an expense. On the cash flow side, when you purchase the inventory, you do have to pay for it regardless of whether you've sold it or not. So we had this, clash here, because cash flow for a transaction doesn't match the profit. So we have an outlay of cash to purchase inventory, which we're going to sell at a future point. But at the meantime, we have to outlay that cash, and we've got no actual guarantee we're going to get paid for our stock. That we might take 6 weeks, we might take 6 months, or even longer to sell that inventory. So there is a difference here between timing of profit and cash flow. So there is a difference there. The other area where people get confused is when they buy assets like equipment, furniture. Generally speaking, you don't get the expense or the deduction for that upfront. Now, I know we have various incentives from time to time, particularly for small business, where you're allowed to get a tax deduction for assets that you buy up to a certain amount dollar value. But generally, if you buy an asset, you depreciate it over a number of years. Now, you'll either have to pay for that cash upfront, but you're not going to get the sales, or you're not going to get the tax, the expense. So even though you outlaid cash, the equipment might have cost you $100,000. You might have spent $100,000 of cash, but your depreciation deduction in year one might only be $15,000. So we have a difference there. So we've still got a profit, say, of $85,000, but it's cost us $100,000. So there is a difference. The other difference is when people loan money to their business and take money out of the business. So initially, during startup, business owners will contribute funds. So they're creating a positive cash flow by creating funds, by injecting funds into their business, which has no effect on profit. It's a loan, and it has no effect on profit. So we have a positive cash flow, but no profit. So there's a difference there. On the other side as well, when we get a bank loan and we're making repayments, that's a cash outflow, but it doesn't affect the profit. The interest cost of those loans does affect the profit, but the interest and the loan repayment are often very different. So we have that difference between profit and cash flow. One way to improve our cash flow is to sell more at a profit, to sell our product or services at a value which exceeds what it costs us to produce. So we're going to, one, make a profit on it, and two, have a positive cash flow generated from it. So some of the other issues, just in summary, that could cause a cash flow problem is selling your products or services at too low a price and not making enough profit on each sale. And this comes back to knowing accurately how much profit you're actually making on your sales. So you need accurate information to be able to tell that. If you continue to sell at too low a price, you're not going to make enough profit, and it's going to be a while before you find out. So unless you've got accurate information, you're not going to know. You need to manage your cash flow efficiently, and that means you've got to monitor it regularly. often paying higher interest costs or using the wrong type of finance. So credit card finance, when a loan would be more appropriate, you pay a much higher rate of interest. That's an example there. And we talked about inefficiency in your business processes. So if it's costing you more to produce your sales than it should, then you're going to have a lower profit and also a lower cash flow. And a risk that's pretty much highlighted at the moment and is a big risk is having customers that become delinquent, end up bankrupt, or simply disappear, or just can't pay you. So you may have made the sale, you've made a profit on the sale, but there is a long delay of getting paid, or worse, that you don't get paid at all, and then that ends up being a loss on the sale as well. And that's something we want to avoid. So number 3, we're going to look at inventory. And inventory, again, I'm talking not just about physical product, but about services as well. So even when we're talking about a service, we know how much it costs to produce a service or to supply a service. So we do need to look at what's the cost of supplying a product. We need to know what's on hand. So we talked about buying $5,000 of stock and only selling $500 and having that sitting on the shelf. If we don't know what inventory we've got, it's hard to make sales of that inventory. If we don't know how much it's costing us to produce a product or to supply a service, we're going to get our pricing wrong and we're not going to make profits. So we do need to look very carefully at our inventory, and we're not just talking about physical inventory, but we're talking about services. So looking at measurements of how much profit we're making, how quickly we can sell the inventory. So how many days does it take us to sell inventory from when we purchase it? Or how much does it cost to supply? And sometimes the cost of supplying inventory includes add-ons like freight, insurance, warehousing costs. How much does it cost us to hold that inventory on hand? Often you have no option but to buy inventory in quite large numbers in advance, particularly if you're importing from overseas, when you often have to buy a container of stock at a time, and usually you have to pay for that inventory before it leaves the factory. So again, knowing what inventory sells and what you can sell it for and the profit you're going to make. If you're able to pre-sell inventory before you have to pay for it, then that's an advantage. Certainly is being able to sell most of your inventory before it actually hits the warehouse is great. And we do need to be careful about timing of how long it takes for inventory to be produced or delivered. Because if you're paying for something up front and you've got to wait 6 weeks before it arrives in your warehouse, and then you need to sell it, and it might take you 6 months to sell that whole container of inventory, we're looking at 7.5 months before you make the sales that you needed to make to pay for that inventory and make a profit. So we need to look at inventory, but we're not just looking at the dollar value of inventory, we're looking at how much it costs to supply, how quickly it takes us to turn it over. So we're not just looking at pure financial figures here. If we don't have accurate and up-to-date records of our inventory or our services and costs, we've got a few things that can happen. So we could end up with a lot more material or stock than we think we need, than we think we have. So we might have a couple of boxes of inventory hiding in the back of the warehouse, which we weren't aware of, and we haven't been trying to sell it. And that's because we bought it at a discount. We've had that stock sitting there for months or even years because we bought it at a huge discount, which is too good to refuse. Problem is we've been sitting on that stock for 2 years and it's not moving. So that's caused a problem because it's eaten up your cash flow, but you're not getting any sales from it. And when you do get around to selling it, it's probably been a bit soiled. You won't be able to get the full price, so you're going to make less profit on it when you do sell it. yeah, that is not a good thing. So you need to be able to sell stock quickly. Stock shrinkage is a issue, particularly where you're warehousing. It's not so much a problem with just-in-time deliveries, but where you do have warehouse and you have a high volume. If you don't have controls over stock, then how much stock is actually disappearing due to theft or misuse. The other one is where you're dealing in perishables and you're unable to sell the product before it goes off or before it's past use by date or saleable date. We need to monitor that sort of shrinkage. And if shrinkage is something that can be controlled, because if you are consistently unable to sell, say, 20% of the day's produce, then you need to look at how much you're actually producing each day. It's better to miss, I think, one sale of $5 or $20 than have $200 of stock left over at the end of the day. So you need to monitor how much stock is actually selling, particularly if you're dealing with perishables. So what stock do you actually have on hand? You can't sell it if it's not there. And if you've got stock that you don't know about, it's very hard to sell that as well. Or you might actually order more of it, not knowing that you've actually got stock on hand. And look, how long does it take you to get supplied by your suppliers? How long does it take from the date you order it to when you get it in your warehouse? For some times that could be overnight or a week, but other times it could be 3 months. You just need to know for each supplier how long it's going to take before your stock arrives, and you can sell it. And then what items are selling and what isn't. There's no point ordering more stock of something that isn't selling. Otherwise, you're just going to have it sitting around. It's going to be obsolete stock, and then you won't be able to sell it at the correct price. So the other thing there is looking at what profit are you making on each inventory item. Because if you don't know what the inventory is selling, how quickly you can turn over, or how much it really costs, you're not going to be able to price it properly, which means you won't make the profit you need to make. Debtors, accounts receivable. Now, fortunately for a lot of businesses, they don't have this. A lot of businesses sell and it's basically cash on supply. So when you supply the product, you get paid straight away. So a lot of businesses don't have this issue, but it's still quite common that you supply your product or services on terms, whether that be 7 days, 14 days, 28 days. And that's often called debtors, or accounts receivable is another term that you will hear. And what we're looking at is how long do customers take to pay? So if your terms are that you want your customers to pay you within 7 days and they are taking 20, 30, 45 days, then you're missing out on the cash here. So this is where your sales and your debtors are linked to your cash. So you've already paid for the stock. You've paid to produce the service. So you've outlaid cash, you've incurred the expense. Yes, you've made the sale, so you should have a profit, but you don't have the cash because you haven't actually been paid yet. So the longer your customers take to pay, the worse your cash flow situation is going to be. The longer they take to pay, the more risk that they won't actually pay and that you will have made a sale for which you don't get any payment. So we need to monitor that particularly closely at the moment, but always you should be monitoring that closely. You should have a daily report of your debtors. Now, when I'm talking about these reports, most accounting systems today enable you to produce a report instantly of your figures, so your debtors, your inventory levels, what your profit is and what your current cash position is. And you should be looking at those reports at least weekly, ideally daily. But at least weekly. Monthly, often so much happens in a month these days that you could have well missed an opportunity or been unable to correct a problem in time. So you should be looking at these reports daily. So debtors, very important to follow up. If you're not comfortable with chasing people, there are services that you can use to assist with that, or even automated services that assist with reminders for clients. But you do need to keep on top of your customers and make sure they pay you on your terms. The other side of the coin is creditors, what you owe. Now, these take many forms. A common one is trade creditors or accounts payable. And effectively, that's what you owe for the inventory that you've bought or the services, but basically your suppliers, what you owe your suppliers. Often there is a difference between what we pay for our purchases and what we get paid by our customers. Often we have to supply terms to our customers, but we are often required to pay for products, services, materials upfront, or we have to pay for them before we complete the manufacture process. So how do we manage our creditors? Now, other creditors that come in here as well are payroll liabilities, such as you're paying your employees, withholding of taxes, annual leave provisions, superannuation, your GST and your taxes. So we need to keep an eye on those and monitor them. Now, if that situation is getting out of hand, that's where you need to keep an eye on your cash flow and look at ways you can fix that. And it might be a short-term issue. So do you have a short-term need for funding, or how are you going to supply the additional cash? If you're going to run into a period where you've run out of cash, but you've got payments coming in from customers, then it's worth talking to your creditors and just mentioning what the situation is. In most cases, people are pretty accommodating and will allow you to defer payment, but that shouldn't be relied on and it shouldn't be a regular occurrence. We need to monitor our cash flow so that doesn't become an issue. So monitoring our figures, very important. I mentioned at least weekly, daily is ideal. And with the accounting systems we have today, there is no excuse for not having that data available to you or not being able to run those reports. So the key things we need to be looking at is profit, cash flow, our debtors balance, our creditors, what we owe, and what our inventory levels are. So need to monitor those. And if we monitor them, we can actually identify whether we need to do anything, whether we need to take corrective action, or whether we can actually say we've had a good period. Our sales were strong, we made a profit, and so it was a good month. But we need to monitor those figures every day, at least weekly, and keep on top of it. Are you still making the profits? Are customers paying on time? Is inventory selling? Keep on top of your information and know where you're heading. Do you need to change course? Do you need to run a sales program to clear inventory that isn't selling or isn't moving as quickly as you need it to? So just on that, what are we looking at? So we've talked about cash flow, profit, inventory, the financial results. So often people look at the financial reports, and it's important to understand that those reports we're looking at are what we call lag indicators. So you might have heard these terms before, a lead indicator and a lag indicator. So our financial results are a lag indicator. I'll come in talk a bit more about what that means. So in, say, sport, there's a scoreboard. There's usually a scoreboard. So the players can see the score, and as watchers of the game, and particularly if you're watching on television, we have a lot more information about what's going on the field or the court. We know what's going on. We know what the actual score is, what the percentages are, or the stats are there. And what they tell us is what has happened. They tell us what's going on, what each player is doing. And we can look at all of those indicators. And if a player involved, let's say a tennis player, looking at how many first serves he's getting in and how many points he's winning at the net and those sorts of things, they're all very good to know. And he can certainly use that information, particularly when he's training, to get better. But the score is the main outcome. But the key thing here is that by just focusing on what the scoreboard says isn't going to help the player win the game. They can't change the scoreboard unless they change the way they play. So they need to know what the score is. They need to know what the position is, where the game is at, but they are the ones playing. And it's their actions and the choices they make which will affect the score. So by focusing on the scoreboard alone, you're not going to win. You need to actually play the game and work out what you need to change, what are your strengths, what do you need to improve, and fix each problem, improve each skill, improve each aspect of your business on a daily basis. Because your financial results are the scoreboard. They will tell you how your business went, how much profit you made, how many sales you made, how much inventory you purchased, what your cash flow was. They tell you a lot of information about what happened, but they are just their history. They tell you what happened. You can't change them. You can't change your historical sales. You can't change your historical cash flow. You can't change your profit margins in history. But you can use that information to make changes to the way you operate your business moving forward. And this is where we need to look at things like our lead indicators. So we can look at our inventory level and say what we need to do. If we sell our inventory on hand, this is what's going to happen. But if we can improve the speed at which we make our sales, improve the speed at which we turn over our inventory, what will happen? So we can look at that. But I guess probably the key lead indicator that is really crucial for every business is outside of the accounting reports. So we often get fixated on our financial figures as just being accounting information, but we need to look outside of our financial figures. And this is where a lot of the lead indicators come from, and it's no less obvious than when we look at our sales process. So you're here talking about sales pipeline. This might come up. So what's in your pipeline? And effectively, your pipeline is all of your potential customers, and then your conversion process to take a prospect into a customer and how often they buy from you. So we need to understand what's happening in your business, what is interacting with your customers like for your business, or more importantly, what is interacting with your business like for your customers. Is it a great experience or is it an average experience? If it's a bad experience, then they're not going to come back. So you're not going to get that increased frequency of sales, and you're actually going to lose customers. So how do you attract more customers? So some of the things we're looking at is your website. Is that your marketing tool, or is it your social media? How many people are you interacting with, and how engaged are they with your business? And then what's the conversion rate of all of those visitors to your store, to your website, to your social media, all of your contacts? What is the conversion rate of those engagements to sales? And what's the likelihood? And how long does it take to convert a prospect to a sale? How long does it take to deliver a final product once the customer agrees to go ahead? With retail, it's pretty much instantly. With service-based, it can be much longer. It could be 2 weeks, it could be 4 weeks, or it could be even longer. If we look at construction projects, even longer again. So understanding who your potential customers are and how they interact and how they go from being a prospect to a customer is really important. And this sales pipeline idea is quite interesting, actually, but very important. So looking at your resourcing, it's good to know how many sales you will have in the next period. So if we look at the next 3 months, how many sales are you likely to have, and how certain are you that you will get those sales? Knowing what our sales likelihood is going to be, how big our pipeline is, generating the flow of customers into our business and the flow of sales will help us determine how much inventory we need, how many employees we need to on board. Do we need extra resources? It can help us manage our costs as well as our sales. If we're seeing an increase in interaction with prospects, and we know that it takes from our first engagement with a prospect 2 weeks before they actually make a sale, and we know that they're interested in a particular product, but we know it takes 10 days before we get stock on hand. We need to think about at what point do we order that extra stock so that we can fulfill the sales to those customers. So it is quite an interesting concept. There's a lot involved in it: sales, marketing, but also management and forecasting. So running a business is not just about doing the business. There is a lot about financial figures, a lot about non-financial figures. And a key is you need to know what those figures are and what they mean, and what they mean for your business, and use that information to make a plan. So when you focus on lead indicators, you can improve them. And when you improve your lead indicators, what you're improving is your results. So your lag indicators, that scoreboard, will improve. So if you can improve the number or the proportion of customers that convert, or prospects that convert to a customer, or improve the time frame from when they first become interested to when they make a sale, then your sales figures will improve, your profit will improve, your cash flow will improve. So those lag indicators, those results for your business will improve when you start to focus on the lead indicators, the figures that drive future revenue. So it's important not just to look at the financial figures from the past and what has happened, but look at what are you going to do in the future? What's your business going to do, and what do you need to change going forward? And that's where forecasting and cash flow management come in, and they are very important, and they don't need to be overly complicated, but they can give you a lot of information and the tools to make informed decisions that are going to increase your sales, increase your profit, and improve your cash flow, and improve the strength of your business. So when we do have difficult times, you're going to survive. You're not just going to survive, though. You're going to continue to thrive and grow profitably, sustainably. Because the ultimate aim is that you have a successful business that provides the things that really matter to you. Often that's financial, but sometimes it's in terms of other freedoms like travel, time, quality of life. And the more we actually are in step and monitor what is going on in our business, understand our financial figures, the greater our chance of achieving that success. And a trap for many business owners is that they are so busy doing the business, so busy achieving the next sale, that they forget to celebrate what they've achieved. And celebrating what you've achieved actually gives you that buzz, that energy to continue, but it also helps you recognize that, yes, you've done the right thing. And when you celebrate your success with your employees, then that's a great thing, because it encourages them, they're doing the right thing. It reinforces all that positive, reinforces the good actions, and you end up with a business that people want to work in, that people will want to do business with, and that is going to add to your long-term success. So how do you achieve that? So in sport, plenty of analogies with sport. All the best performers have great coaches. And so it's the same in business. If you look at all the successful businesses, they all have great mentors, coaches, advisors that work with them. It's no accident that the ones who are the most successful have a coach, have a training plan. They use the indicators as feedback. They use those lag indicators as feedback to reinforce whether they're on track, whether they're doing what they need to be doing to get the results they need. And your business is no different. But to achieve the results you want, you must work with an advisor to develop a plan that you can implement that will focus on the things that are really important to your business to achieve the results that you need. And that's what the outcome is. The financial figures are a static thing, but having a long-term sustainable business is the ultimate goal. And focusing on what drives a successful business, those lead indicators, you end up with a much more enjoyable business, a more profitable business, more cash flow, and it's just a much better outcome for everybody. So how can we help? What we find is that many people are following the wrong indicators to start with. They often rely on knowledge gained just from general information or blogs or a mate or self-help guides. But the danger there is that information is not specific to your business. And if you're a business owner, you've got many hats to wear, many different aspects of the business you need to work on. And having the wrong information or not understanding what the processes are or even what the financial figures represent can have some serious consequences, and you can end up in a not a great outcome. You can end up in a loss-making situation where it's out of control. You can't correct it. So I encourage you to actually engage with us to get the right advice on what you should be focusing on, what are the key things that you need to manage, and then how do you monitor that. So our role is to help you design the business that is going to create the lifestyle that you want. And to do that, we need to be very determined and specific about the actions we take and what the outcomes we want from that are. And when we do that, we help you implement that plan. We see what's working, we see what the outcomes are, and we can make those corrections as we need to. And you end up with a situation where you have a very successful business, making good profits and solid cash flows, and you really enjoy your business. And that's what we want to do. So planning and cash flow, as I said, are keys, not just to a successful recovery, but also to building a successful and strong business as we go. So the keys here are developing your action plan. A three-way cash flow forecast is really looking at your profit, your asset situation, as well as your cash flow. So they are related. You can't look at them independently. Key information to give you guidance on where to move forward and what you should be looking at. So thank you for joining us today. And if you're wanting to know more or get in touch with us how we can help, you can certainly reach out to us through any of these methods through our website, or follow us on social media to keep up to date with what we are doing and how we can help you. So thank you again for joining us, and have a great day.